Evening, ladies and gents. Simon Brown here from MoneywebNOW and Moneyweb, of course. Before we start, I just want to confirm that folks can see the four of us. You can see the screens. You can hear me. If I'm getting yays all over the place, if you could raise your hand in the GoToWebinar app so that I know that I'm winning. And I'm seeing some hands. Brilliant. So this evening, we've got a presentation which we'll do in a bit. We're going to kick off with the big question, which is grey listing, Silicon Valley banks, interest rates, and just a fairly crazy market. We were saying just before we came on, if we did it last week, it would have been boring. This week, it's going to be a whole lot less. So then a presentation. If you've got questions, drop them into the Q&A box. We've certainly got time for that. And we're going to do the presentation in the Medical 42. We want to chat markets first. Before that, let me quickly introduce my three hosts: Justin Clarke, OrbVest Operational Director, Emma Swart, who's OrbVest Investment Consultant, and Justin Porteus. Here's PKF Capital. Gentlemen, lady, thank you very much for your time this evening. Really appreciate it, and everyone coming in and attending. We're getting some good numbers coming through this evening. Justin Clarke, and I'm going to use surnames the whole way through because that's how we can identify the two Justins. Let's kick off with you. I think the big question, and there's lots of them, but I think the immediate big question with SVB, Silicon Valley Bank, and other banks suddenly being told to stop trading, etc. Any exposure?
Simon, yes, thanks very much for having us on. It's been a while, so really appreciate you getting us back online. No, we have certainly had a lot of inquiries over the last 24 hours for investors. Do we have any exposure? And I think the answer is twofold. One, we have no exposure to any of the banks that are in difficulty, and I actually got a list of 10 of them now. So, I know we talk about the top 3, but there are others. Secondly, I think the other important point is that we don't really handle funds. We have transmission accounts, but we don't hold investors' capital in any bank accounts of our own. Bear in mind that the way that we operate is effectively the investor moves their money through to PKF, which is of course Justin. So maybe he should be answering this question.
He's answering it next, Justin. You're up next.
Okay, don't let him off the hook there. Yeah, so it's in PKF's escrow account, and then ultimately it moves through to the client's wallet, which is on the merge exchange. So yeah, and then when it moves through to a transaction, effectively we acquire a building, and then the money is used to acquire the building. So we own the asset. And then the only other aspect of it is obviously the gearing, which, as you remember, we gear it to 50%, and the gearing would be through a bank. And even if one of those banks failed, they're locked into the term of the loan. So it's us with their money, not them with our money. So yeah, I think to answer your question, absolutely clear.
Then Justin Porteus, and the question to you, and also if you could start off perhaps how PKF Capital fits into the process with OrbVest.
Yeah, perfect. Thanks, Simon. So PKF basically facilitates things in the Seychelles with OrbVest for both the exchange as well as their transaction accounts, as Justin suggested. So we hold all funds with ABSA. So ABSA being the 4th biggest bank in Africa. I think if ABSA fails, pretty much everyone on this webinar would be in serious trouble, and all of us sitting in South Africa at least. So yeah, we hold funds with ABSA. That's also, it's in a trust account. It's held just with OrbVest client funds. So the funds are positioned for the investments. So it's held there. We then move it to the exchange, which also holds the funds in an ABSA trust account. And from there on, it's moved across to the US. So no individuals hold funds. The funds are not put into any kind of interest-bearing accounts or anything that holds risk. It's held purely in a transactional bank account as cash, and then moved across to purchase the buildings out in the US. We also then manage the whole listing process of all the OrbVest medical suites. So they're all listed through an international business company in the Seychelles, and we manage that whole listing process, and then all client transactions and sales and purchases thereafter.
Okay, perfect.
I'm going to get Emma to cover this one, because Emma is actually a director of OrbVest and is most concerned about our compliance. So Em, if you don't mind.
Yeah, let us just get the disclaimer out of the way. Thank you, Justin. Yeah, so really this is just, if you could all read the disclaimer. small writing, a lot of writing, but basically we are a financial services provider. But anything we discuss or run through here, or any investments made in light of these opinions and or forecasts, please make sure that you are doing this in conjunction with your own wealth advisors or IFAs.
Cool, Emma, thanks very much. So let's get so now we've got the formalities and the concerns and the SPV and Justin Clarke, as you say, 10 banks and probably going to grow, but certainly the contagion has been seemingly very much contained. But there are other challenges that we have sitting here in South Africa. Justin Porteus, if I can come back to you for a grey listing, which is, 3 weeks old now. And a lot's happened in that period, but I mean, not a good space to be for an economy. I mean, there's no silver lining to it, surely.
Look, I think the grey listing thing to some respect was a little bit blown out of proportion to how it's actually affected us as South Africans. You know, we've got a huge amount of concerns in the country at the moment, and I think grey listing is probably one of the smaller ones. We jumped onto we deal with a lot of banks across the globe, a lot in Switzerland, and we jumped into them as soon as we heard about it and said, well, this is coming. It looks like it's coming, as much as we tried to curb it. The Reserve Bank did very well. I think that we as South Africans love to point fingers at the government. The Reserve Bank did superbly. So really pulled up their socks. I think when we started, there were around 69 concerns from FATF of where we are falling short. Just to put that clearly, none of that was really in the banking sector. It was mainly law enforcement, non-financial sector, and oversight by regulators. So we jumped on to all of our banking partners and said, is this going to be any effect to us as South Africans and with our South African investors? And they first said, well, they don't think so. You know, South Africa has weathered many storms, and although we've really dropped into sort of world rankings with our compliance, and we low down on the corruption index, they said they don't think it would affect us too much. In saying that, I had a transaction the day after the grey listing went through to Switzerland and got hit back with a very apologetic message from our bankers there, and saying they required a lot more documentation than usual. So it's going to be mainly an irritant. I think it's going to be something that investors get frustrated about. You know, South Africans are not very patient people at the best of times, and so when guys are trying to move funds offshore, they've got to just look at things and say, this is going to take time. It's not going to be, I'll pay it today and it arrives in an account tomorrow. There's going to be extra checks from SARB. We've actually seen that coming in over the last year. Things that you could do 24 months ago, you couldn't do last year and this year in terms of paying out. There are a lot more documentation that's needed. So investors just need to have all their ducks in a row. So it's not a matter of just saying to Investec, look, I'm paying my money out, can you move it right now? You might need to answer a few questions and just say what the money's going for and all the rest of it. So as long as your tax fares are online and you're a pretty upstanding financial citizen, I don't think you have any issues. It might just be an extra day or two to get your funds across. So from that mindset, it's not.
Sorry to jump in there. I think Emma had a very interesting client the other day that was already approved to move their 10 million Rand allowance. And maybe you just want to just give that a bit of color.
Just with regards to the additional information, you know, you've got your Reserve Bank approval, and then still was, you know, had got the PIN numbers, etc. So you know, you feel that you have passed all those checks and balances. You've done the audit. You know, and it's come back that they are now, you know, re-auditing him. So just when you think you're in the clear, you know, they do still have the right to come back and reopen cases and re-look at information. So again, I think with that specifically, this grey listing, you know, there is just now a lot more information and documentation that has to be provided.
Yeah, it is that. It just seems to be, it's more admin, it's more paperwork, it's painful, but as Justin, as you said, and if your fares are in order, then it's just a a little bit of extra effort, and not a spanner in the works by any stretch of imagination. Justin, Clarke, if I can come back to you, interest rates. When we started doing these webcasts, which were back in the deep pandemic, we were all stuck at home. Interest rates at just as a response to the pandemic at absolute record lows, and have been crazy volatile as of late. We've got a chart I'm going to pull up now. It's been a crazy place. Indeed,
Simon. If you remember that, as I said earlier on, we gear 60% and 40% investors' equity. So when interest rates go up, it makes it very difficult to acquire any assets and still have a nice delta between what we're paying and what we're earning. And what we're earning is how buildings are priced in the market. And I think I'm not going to get into too much detail of it, but it's a cap rate. And a cap rate is basically the cash return that the asset would provide. And normally what happens in an active market is that the price of the buildings move in line with interest rates. So as the interest rates go up, there's less buyers in the market. So the cap rate goes up, which means the prices have effectively come down on the building to make extra space for that little bit of investor delta. So I think quite simply, it became quite difficult for us to judge where the market was going to go, and that's why we haven't spoken for a while, Simon, because we effectively have been being very cautious and staying out of the market until the dust settles. And the other thing about healthcare and medical real estate is that there is a movement of money out of the markets into this, because it's obviously seen to be as a very safe sector, and especially as there's a lot of real estate, commercial real estate, that you don't want to touch, like office, for example. So you've had this additional capital coming into the market, which has kept the prices high, and the interest rates have climbed to the point where there's basically no return. So it's been very difficult, and we have been watching the market, and I think that now what's starting to happen is you're having a little bit more correlation, and prices are starting to drop a little bit. You're getting some more desperate buyers that are offloading properties. And that's why we're so excited by the property that we've just found in Duluth, because it's really finding a needle in a haystack at the moment. But anyway, sorry, the question was about this graph. And I think we watch this, certainly our team in the US watch this all the time, and look at the drop off at the end of this graph. And effectively what this is the US interest rate outlook, and it's the various US treasuries, including SOFR. And so you can see that if you go back a couple of days, you'll get rates that are sitting up in the sixes and sevens. And in fact, we're borrowing money at the moment on buildings at 6.25, and that's probably going to go up. But you can see that the 2-year money is 4.1 and 10-year money is 3.5%. So what the market's effectively saying is, this bank contagion is definitely going to put a brake on interest rate increases, and so the market is repricing this debt at 3.5% over 10 years and 4.1 over 2 years. And our 5-year money is somewhere in between. In fact, it's 3 point something up. I didn't highlight it on this graph here. So I think it's really fascinating, Simon. I think this graph is super interesting, and it's amazing how reactive the markets are to movement, on the macro environment. Yeah, I love graphs, and graphs like that absolutely stand out. What about inflation? We got US inflation out earlier today, 6% month-to-month core at 0.5. It looked like a print that was pretty much in line. That said, again, 3 years ago when we started these webcasts, there was no inflation, and now there is a whole bunch. I think my colleague Martin Friedman, who we've had on a few times, Simon, his best source of information is on his Harvard WhatsApp groups, and I think the consensus that there's going to be a very slow increment in interest rates, if any, and this is exactly what the Fed is looking for. They don't want to push the economy into recession. They want it to have a nice soft landing, and it looks like that is what is going to transpire.
Cool. I want to bring in the presentation. Let's start going through the medical 32. Justin Clarke, sorry, 42. Justin Clarke, we'll kick off with you in the process. This was the other slide we wanted to quickly touch on, which is just currency. And this is, I was going to say, a picture says 1,000 words. In this case, it's about 30 numbers that say the words in terms of the currency. I think earlier today, sitting 1810. Yeah, strengthened a little bit, but generally looking fairly weak.
So yeah, I'll kick off. But Justin Porteus Porteus is moving money all the time around for his clients overseas. But I think it's fascinating that we have a lot of investors that say, "Whoa, the rate at 18 is really bad." And I remember when I was first exposed to this business, Simon, guys saying, "Whoa, I don't know if I can move money at 12. That's just very expensive." And so you can see over time, sort of the fundamentals of our economy, which is really, really underpinned by commodities. Yes, there will always be a little bit of comeback in commodities that'll strengthen the rand, but ultimately, I think we're pretty sure that there is a very clear direction that the rand is following over years. I don't know, Justin P, what's your view on this?
Yeah, so we've been looking at quite a lot of analysts and reports on the rand at the moment. Obviously, it's changing at a wild rate. It can swing by about 20, 30 cents a day, just about every day. Yeah. What has been happening, it's been ending almost every day slightly higher. So today is the first day where there's been a bit of recovery. But that might look like recovery in the rand, but it actually could just be weakening in the dollar. So the dollar yesterday strengthened quite nicely as the markets sold off. So obviously selling off in markets is going to strengthen the dollar. People are looking for safe havens. And then today markets were up. So money back into the markets, dollar weakness, rand strengthens a little bit against the dollar. So it's very difficult to look at it as a pinpoint thing in terms of what's happening in South Africa, which is obviously a bit of a dire picture at the moment. But you can't look at it and just say it's rand weakness all the time. There's got to be dollar strength built into that as well. So when you look across hard currencies in totality, I would say the rand is, at a sort of buying point, if you want to call it that, at above 18. But Investor came out with a bit of a report looking at this year and the forecasts, and the 48% forecast that they had, which was a kind of balanced one, which was sitting at, we're ending the year at sort of 17 odd dollars to the rand, but there were very dire reports there as well. So looking at worst case scenarios, I mean, what could happen politically, EFF and ANC joining forces, things like that, where we could be sent into the $20 figure, so 20 rand to the dollar. So yeah, it's a guessing game. If anyone tells you they know what they're doing there, they are lying to themselves, if not you. But yeah, it's one of those things. I mean, I've got so many clients now that have said, "Well, we're going to hold off on moving money out," and I've got clients thinking they should move money back in. I mean, I bought some rand the other day, so it's more just do what you need to do. You need to diversify yourself. You need to put your money into diversified portfolios. If you heavily invested in South Africa in terms of your own property, and obviously now probably buying solar and generators and inverters left, right, and center, then to send some excess cash off. But looking at, I mean, if you're going into medical suite where you're aiming at 8% return, to go and take it out when it's at an obvious high at sort of 1840, 1878, I think we got to the other day. So you don't want to be silly and lose 10% off the cuff just on the currency. So you've got to try and time it somewhat, but yeah, timing it is a guessing game.
But that is the rand. I mean, it's almost impossible to. The certainty we have and what that illustrates is that it weakens over time. In the short term, it moves around. I just have a very simple. I move money according to a schedule, and I just run with that because it removes the pain of me trying to be an FX trader, which never really works. Justin Clarke, let's come back to you. Let's have your kickoff, and then we'll come to Emma in a moment on the new building you've got.
Yeah, excellent, thanks. So let's talk about Atlanta for a second, Simon. Atlanta is a very interesting city, and I think it's certainly not the first city that South Africans generally visit, because it's not a great tourist city. I can tell you, I tried to look for some tourism to do there last time I was there a month or two ago. And apart from, unless you want to visit the Coca-Cola factory and get some sugar poisoning, There's not a lot else to do there for fun, but it is actually a very beautiful city, very much bigger than you would anticipate. To go through that the airport in Atlanta is, and I'm told that it is back to being the busiest airport in the world. It is just a very scary place. It makes our airport seem like a little regional light aircraft airport. But most important, it is one of the most important gateway cities in the US, with a large chunk of Fortune 500 companies, and it is about 6 million odd residents, and it's got the highest concentration of Fortune 500 headquarters in the US, and that's probably because of the location. Bear in mind that it is the gateway to the rest of the US. And our hypothesis has always been that Atlanta is one of the strongest cities for us to acquire medical buildings, purely because the market is just so large that if you lose a tenant, there's another 100 that you can pick from. Whereas if you're in a very tiny little location, there isn't another, whatever it is, a cardiologist that's ready to take that suite. And so we're always very pleased to find something in Atlanta. And this particular building is situated in Duluth, which is a very upmarket area. For those of you who play golf, Sugarloaf golf course is right there. In fact, a mile or two away. It is about 3 miles away from the Northside Gwyneth Hospital, which is a reasonable sized hospital. And bear in mind, there's always a synergy between the hospitals and these little dental. And by the way, this is a dental node. And I'm going to pass over to Emma to talk a little bit more about it before I spoil the story. But I just wanted to say that this Atlanta is a fantastic market to be in, and particularly this area is where all the growth is happening, up the interstate corridor, and yeah. So I think let's talk a little bit about the actual deal. Em, maybe you can come in.
Perfect, thanks, Justin. So, I mean, this building we are very excited to have found. As Justin mentioned, we haven't brought anything to market for the last 5 months. This building is 22,555 square foot, 100% occupied, all biomedical. There are 7 tenants, of which 6 of these tenants are dentists, dentistry focused. So we have a really wonderful dental node building, which are all medically focused. Again, just from a location point of view, close to the interstate. Again, as Justin had mentioned, again, close to the hospital, which is great referral work from the hospitals into this building. Again, the shift and the trend from your on-campus being your hospital treatments to these off-campus medical centers. Another thing we really loved about this building is that all the leases are triple net. So again, all expenses are passed through to these tenants. Again, the question around, increasing inflation and how that affects us. When we have these triple net leases, the expenses that are incurred with this inflation are then obviously passed through to our tenants. So thankfully for us, that doesn't affect our bottom line from an income point of view. Again, as we've seen there, all core medical or dentistry, and one is an obgyn, which we'll touch on just now. The building itself, if we go to the next slide. The building itself is a very simple building, 7 tenants, 6 dentistry, 1 non-dentistry, but still medical. And what we love about this too is it's a very simple building, single story, no escalators, no elevators, no massive common usage areas. From a maintenance point of view, this is a dream. Again, the way it is situated, your parking lot in the middle there, really easy access for your patients to come in to see their specialists. And again, great synergies between these dentists, which refer to each other. So they're again, the building is simple. The synergies between the tenants is absolutely, paramount and fantastic. The the maintenance is great, and again, the proximity to that hospital, which we've touched on. The building itself was built in 2006, with many of these tenants that have been in this building for 5, 10, 15, 16 years.
Cool. Let's bring some numbers up and touch on those. Emma, a couple of questions came in on triple net lease, which is you touched on it there, which is that it really is the responsibility for the what is it? It's insurance and maintenance and utilities is for the tenant.
Correct. So all expenses related to that tenant and their spaces pass through to them. Wonderful. So if we look at that slide now that Simon has pulled up, we are looking really at the market comparisons. So we're looking on the first graph, the property's weighted average rental, we'll see is slightly above the market average of Duluth. Our rental average is $23.45 per square foot versus the market average in the fourth quarter of 2022, which was 22.81 square foot per square foot. This is, however, what we would expect for this type of building. It really is an absolutely superior building, 100% tenanted, fully medical, and this building has been, tenanted for many, many years. And again, with those triple net leases. If we look at that second graph there, that just shows that the property was acquired at $324 a square foot versus our market average of $326. So we are well in a market-related purchase price, on this building. Again, the building in an area that is underpinned by, the absolute right fundamentals. If we go into the next slide, we can actually touch a little bit on the tenants specifically. As I mentioned, 7 tenants, 6 of which are in this dentistry node, and the 7th being the Georgia Obgyn Society. These tenants we look at, and as we say, some have been in for 5, 10, 15 years. And I think that one of our key driving factors with this building is we've seen how the synergies between these dentists work. We've had a similar building with our Medical 35, I think it was, where again, a lot of focus on these dentists. They spend years in these buildings, building up their client bases, and a lot of their patients, they refer to each other. With all of them having slightly different specialities within this dentistry space, they are loath to leave the building and leave the area because they would therefore lose their market share, and again their referrals to each other. So we, again, with that Medical 35, if we look at that, we had 1 year 3 of the dentistry tenants leases coming up for renewal, and they were, all 3 of them had renewed those leases. If we look at that second slide there, again, the graph, what that shows is the yellow line, how long those tenants have been in this building, extended to the grey line, where we are then anticipate renewing those leases. And you can see that there is a very long lease profile with these tenants. On the investment committee, one of our biggest concerns was the weighted average lease term of these buildings is below our desired 5-year vault, this one being 4.74. But again, when we looked into it and took a deeper dive into the tenants, who they are, how long they've been there, how many times their rentals have been renewed, they have continued to sign these 5-year leases, 5 years after 5 years after 5 years. So the trend with your vault is always going to be just below your 5 years. And again, with all of the synergies and the underlying fundamentals that underpin this, we are very comfortable that we will keep these tenants in this building.
Cool. Justin,
Perfect.
Clarke, are you going to come in? Emma, are you going to stay with the capital structure? Let's run through some numbers.
Yeah, I'm happy to touch on that. So really what this shows on the project capital structure is the purchase price of the building at 7.65 million. Again, what Justin had touched on earlier, we're purchasing this at just above a 7% cap rate, which is something we haven't seen for the last 5 months. As Justin touched on, we are going, we're looking at buildings 5.5% cap rates, and our borrowing rates were 5-6%. It just didn't make sense. This one was an absolutely beautiful building, managing to pick it up at just above a 7% cap rate. So these numbers have made sense to us. Everything on this capital project structure, from a cost point of view, is any expense that we will incur, that we foresee that we may occur within this 5-year period. And we cash flow it in to make sure that if any of these expenses are incurred, that we are still going to be able to produce the returns that we would like to produce. Included in there, obviously, your bank fees, your due diligence fees, property assessment reports that are done, any interest reserves that we may make, that we may hold back. So really, it's every expense that we could possibly link to this building to ensure our returns are still there. The amount we financed is just below that 60% loan to value on this building, 59.69. And another big thing we looked at is that debt service cover ratio. From a bank requirement point of view, they generally look at around 1.25 times debt service cover. We always like to be closer to 2 times debt service cover. And what that means is that 50% of your tenants don't pay their rentals, and we are still in a position that we are able to cover our debt with the bank. So it just keeps it very comfortable. Again, we have moved away from having partners or sponsors in the States when we're purchasing our buildings, where we now are the GP, the LP, and OrbVest, owns this building on our own with our investors. So you'll see there the split from the equity carry profit split is 80% to the investors and 20% to OrbVest. So that means obviously when we exit the building, 80% of the capital gain of the building, the upside, is distributed to the investors, and 20% is earned by OrbVest.
Hold on.
The next slide here. The next slide is what everyone wants to look at in terms of, what are the returns and what are we forecasting here. That first section is for USA accredited investors. So that's if you've got your LLCs, if you are investing directly from America. The bottom one is international investors. That's for, as South Africans and any other investors from the 30 different countries that invest with OrbVest. So what that is showing is that we anticipate in year 1 with the cash flows to be giving a 7% cash on cash return per annum, paid quarterly. And then that escalates to the 7.2, 8.1, 8.5, and up to 9.2. When we're looking at exiting that building, we are looking at an internal rate of return range between 10 and 11%. I think a thing to mention here would be, question is how are we going from 7% in year 1, with your escalations on the rentals, to a 9.2% return in year 5. And what we have done here is, if we rewind back to Justin's graph in the beginning in terms of the long-term cost of money, we, from the deal funding team, have secured a 5-year fix. We always fix our interest rates for the term of our loan so that we can mitigate the risk of obviously increasing interest rates and that debt service cover running away with us. So we, in this case specifically, we managed to secure a 5-year fix for our money at 6.25%. I think it was maybe 6.5% for the 5 years. However, within that 5 years, they have allowed for us to break that fix without any early settlement fees, any interest breakage costs, and refinance that. So what that allows us to do is, if we look at the trends and what we anticipate, we've said within year 3, which is where we see, the interest rates may be coming back in our favor, we can then go back to our South Bank, which we're doing this deal with, and negotiate with them to refinance this deal and obviously better our interest rate, which then betters our return purely on the arbitrage there of the interest rates. However, from a security point of view, if interest rates don't do what we think that they're going to do, then at least we have secured our 5-year at the interest rates, and your 9% may be 7.8, but at least we have the option to have a breakage within that time period.
Folks, before we do the last slide, if you've got questions, there are a couple coming in already. Certainly send your questions through. We have got some time. This is the very much the key highlights which we touched on up top on the presentation. Justin, Clarke, I've got a question which I want to quickly throw to you, and I know it's one that we have chatted over lots of times. But Sean's saying, what makes medical tenants the preferred client type?
Oh, that's my favorite question, but we need a bit more time, Simon. Can you do another half an hour? Yeah, I think yeah. So I think let's talk about this building specifically, Sean, because in a multi-tenanted building that has medical specialities in it, and I'm going to touch on general trends. Okay, I don't know how to do this in a short way, Simon. You're going to have to cut me off if I'm too long. Number one, there's a trend out of the hospital systems for a couple of reasons, but one of them is cost. If you go into hospital 10 years ago for hip hop, you're there for 5 days. Today in the US, you can go into a medical office building, have the procedure done in a surgery, and just remember that, in the office building right next to the orthopod, and be released the same day. So that's what's driving people out of the hospital system into the offices. Next thing, you may ask, why is that tenant sticky? Well, to build a theater inside a medical office building, you can't really close your laptop and go and work from home. You have to do the theater in the theater, and it's very expensive to have a theater. You've got to have generators and backup generators and oxygen and special roof heights for the robotics, and so the cost of fitting a tenant into a medical office building is often. In fact, there's certain machines which we have in our buildings that cost more than the actual building does. So effectively, they want a long lease. And you can build in your cost of building out that suite for them and amortize it over the cost of the lease. But let's move back quickly because I can spend a lot of time on that. But quickly onto dental. Bear in mind, dental also has quite a setup cost. But apart from that, the data shows that first of all, dentists can't work from home, guys. So if there's a COVID, you're not seeing your patients at home. When you have to go to a dentist, you have to go to a dentist's office. There is fit out, and when a dentist leaves and relocates, dental patients tend to stay with the practice and not go with the dentist. And I know that doesn't feel right, but that's exactly how it is. And I'm going to bring you back to the fundamental. Think about your dentist or doctor. How often have they been in the premises they're in at the moment? They generally don't move. So why we like medical, they always want a long lease, they want security, they're very good tenants, they're professionals, they can't work from home, not like an office tenant, and they generally have quite high costs of installation in order to be there, especially in the US, where there's all sorts of other interesting regulations around dealing with medical and hazardous material and oxygen and power and all those things. So I think that's the shortest I can make it, Simon. Sorry for that.
No, that's perfect. And I remember the one time you said to me, when last one of my medical practitioners moved. They don't, I move. And then I once lived in Durban and went to a dentist in Pietermaritzburg because that's where my dentist was. I wasn't going to try and find a new one, but they never left at all. A question coming through from Sean, and Emma, I think maybe this one's for you, and you did touch on it to a degree. He's talking around maintenance, and you said this is a low maintenance building, and B is in good shape, but obviously over time, he says your refurbishment and technical upgrades. I mean, you've factored that into the numbers, that there is going to be potentially some work needed on the building over the period.
So I think again, back to that one, from a property assessment report, when we do the due diligences, there is a mountain of information that is given to us in terms of, what expenditure do we foresee needing to happen on this building? Obviously from a structural point of view, and then just your day-to-day type of maintenance. This building specifically, for example, what we love about it, there's no centralized HVAC, which is a air conditioning system, where if something goes wrong, you have to come in and replace the entire thing. Each building, each room itself has got its own aircon unit. So if something goes wrong, you can step in and it's a relatively cheap exercise to change. So, we go into that detail and look into every cost that we foresee would be out of the ordinary. If we look at the roof, we'll say, is the roof going to need a lick of paint, or are we going to have to structurally rechange, and fix that roof in our 5-year period? If that was going to be the case, then we would need to factor that in as a capital expenditure on that building.
Gotcha. Another question coming through, and I'm pretty. Yeah, Justin.
Yeah, so that property report is fascinating for us South Africans, because there's so much data available in the US that these reports are. Emma, the last one I saw was 169 pages on one building. So they literally comment on the fire extinguisher expiry. It's bizarre. It's very expensive. I must give it to you, but they will tell you what the capex is on that building for the next 10 years.
Question coming in, which Emma you answered, and that's around what is the minimum. If I recall, you said $5,000, and this is offshore money. This isn't in rands. This is money you would either have offshore or would take offshore.
Yes, so from a South African, if you're sending money offshore, obviously you've got your single discretionary allowance that you can all take without your Reserve Bank approval. Alternatively, if you already sent that 1 million rand, per individual, you'd need to apply to the Reserve Bank. And then if there's any money already sitting offshore, then obviously that can be invested. We've got investors from 30 different countries, so we have money coming from all over the place.
Justin Clarke,
Simon, I think
yeah,
you're on a good point there, because I think a lot of people misunderstand offshore investment to what effectively we're offering through PKF, because very often when you're investing offshore, you're investing in a local company in South Africa that's then taking the money out and investing offshore, as opposed to this, which really is completely offshore. I mean, it's got nothing to do with South Africa at all. So I think that's an interesting point.
And I think a good point in that, Justin, is that then your money is offshore. Your dividends that you earn at between 7 and 9% are paid offshore in dollars. They don't have to come back to South Africa. So your returns on dollars, they can stay offshore. You can reinvest those dividends into, the next opportunity that comes along from OrbVest. So that money once offshore is invested offshore, dividends are returned in dollars offshore, which you can then reinvest or withdraw those funds elsewhere.
Justin, a question coming through, and it's on my Twitter account. Someone's asking, when is the deadline? As I understand, this is a capital raise, and you're not going to sort of close it on Tuesday. You'll hit the capital target.
I think that's a great question. So we are nearly finished our DD period. At that point, we have to go to the investment committee and get the final approval, which will happen in the next 2 weeks or so. And then we've literally got another 45 days, I think, to close. So it's mid-April that we need to close, so that's when we would. That's effectively after that you start earning. As soon as we close and own the building, then you start earning money on your investment.
Perfect. Ladies and gents, we have hit time. We promised to keep it to the point. So we will park it there. I know there are more questions coming through, but also, folks, some of them were answered, and you can go to the website. There's a whole bunch there. Justin Porteus, Justin Clarke, Emma Swart, all appreciate your time very much today. One last question, which I do want to quickly take, which is, and it was someone asked me about it recently. You've had the almost the collection of buildings which you put into one fund. Will you be considering those again in the perhaps near term?
Yeah, I'll take that one. one of our favorite products, Simon, is the diversified product. And effectively what we've done there is, property is not a straight line always. And Emma said, if you've got a big HVAC system and it blows up, you've got to fork out $80,000 in 1 month to go and repair it. And if it's not budgeted for, then it's going to impact the return in that particular month. So we created this. I'm not allowed to use the word fund, so you can just rub that out.
Yeah, not a fund.
But effectively, it's a listed company through PKF and the Seychelles and the Merge Exchange, and we have put 20 shares in 26 buildings into that one company. We call it ODH, OrbVest Diversified Holdings. And since inception, it's paid over 7% cash on cash, and the underlying investments. I mean, you can see all the buildings different to a fund or a REIT. You can actually see all the buildings and the returns that they're generating. So, it's a very nice product if you just want consistent returns and you don't want to worry about, having a month that you're in trouble. So
yeah, and that one
we really love that product.
So I say that one is available.
Okay.
Yeah.
A very last question, which perhaps is pertinent, and I honestly don't know if anyone here can do it. Justin Porteus, maybe it's for you. Is this deemed a capital or an income asset, which has different tax implications? Any of you tax experts? I'm not the tax expert.
Yeah, so basically the returns are dividends, not interest. So you'd be paying dividends tax on that. And then at the end, if there's a sale of the asset, then there would be a capital gains tax on your initial investment. So not an interest bearing, so not income tax.
Justin, just I'm not sure if that's quite right, because in the Seychelles it's tax free, so it would be paid out as a dividend and return of capital. I think that's how it works. Certainly, that's the way that we've been doing it in the past.
A South African individual they pay tax on worldwide assets, so you would still pay tax on the dividend that's paid in the Seychelles, whether you get it into South Africa or not. You'll have to declare it on your tax return locally.
Yeah, and always speak to your tax expert, because they get paid a lot to do what they do. We're going to leave it there. Justin, Clarke, Emma, Swart, both of you from OrbVest, appreciate your time, folks. OrbVest.com if you want more. And Justin Porteus, he from PKF Capital in the Seychelles. Ladies, gentlemen, thank you very, very much for this evening.
Cool, thank you.
Thank you, Simon. Thanks to the audience.
Ladies and gents, thank you very much for your time. Until next time, cheers all.
Cheers.
Cheers.